So back in August of 2025, earlier this year, there was a proposal by National Treasury as part of the Tax Laws Amendment Bill to make some adjustments to the Income Tax Act of 1962. There's a specific section in there. We won't bog you down with the details. The long and short of it is that there was going to be a removal of a tax exemption that was placed on foreign pensions. This has been reversed by Treasury as of today, and we're going to take a look at this and see what implications this would now have. I'm joined on the line by the team lead for cross-border taxation at Tax Consulting South Africa, John-Paul Fraser, to take a look at and see what we make of it. John-Paul, lovely to have you on the show. Thanks so much for taking the time. Let's start with an understanding of the implications of this particular exemption and why Treasury sought to remove it.
So I think a very good starting point. Needless to say, a starting point in that regard is that this was never meant to be a long-standing or permanent provision. However, it has been in effect for 25 years now. So based on that, an alternative law is to bring certainty. So this exemption relates to pension funds that have been invested in offshore. They relate primarily to those South Africans who seek brighter futures, let's say in the Middle East, America, UK, to earn a bit of income for their retirement and their families back in South Africa in return. It also affects those foreign nationals who look to retire into South Africa just because of its natural beauty, whatever the case may be. Needless to say, those individuals who are either coming back or relocating to South Africa bring with them large amounts of investment and capital based on their foreign pensions. So it generally applied to those categories of people. And in that regard, is obviously where that exemption then gets removed is a big deterrent for those individuals to actually or incentivize coming back to South Africa or relocating to South Africa. So the words to simplify it is it went from a 0% tax to all of a sudden being a full tax on their foreign pension, which obviously has been planned for, let's say, 20 years,
Now, John-Paul, today there was a meeting with the Standing Committee of Finance to discuss this amongst other issues. Can you tell us the conclusion of that meeting and what the current or what the new position is on this particular section?
Yeah, perfect. I think what I must commend the process on itself is that they did, or Parliament, National Treasury and SARS did hear out stakeholders and did take comments and submissions into consideration. And where it was proposed to completely remove this exemption and tax foreign pensions, the outcome of today was that the proposed amendment removing this exemption has been withdrawn. So they refer to it as partially accepted in terms of us submitting that it should not be implemented. So they've gone back to the drawing board essentially to see how they can go about doing this in a manner that it wouldn't have such negative consequences that it would have had at this stage.
So, John-Paul, to be clear, we are not completely out of the woods. There is always a possibility that this particular exemption could be looked at again in future and Treasury could take a different decision. But for now, there is a bit of reprieve for those that have the foreign pensions.
Spot on, correct. And I think a highly needed reprieve considering that it would have taken effect from 1 March next year already. So very short notice if it did get implemented.
John-Paul, I want to take a look at the double tax implications for South Africans in particular that might have offshore exposure and that might have offshore transactions that also coincide with their local transactions or their local investments. Can we perhaps take a look at that in the context of, one, the pension and the retirement planning, but also just where this kind of decision by National Treasury leaves them and leaves SARS if they're looking at the future of these sort of relationships?
I think a great question. And firstly, I must say that the sole purpose or the main purpose behind this amendment was to eliminate what's called double non-taxation. So individuals who have pensions or coming from the UK, for example, that double tax agreement between the UK and South Africa provided that you are taxed where you are a tax resident, for example. So where you come to South Africa and you have a UK pension, or you've worked in the UK and you come to South Africa and have a UK pension, you would then be taxed in South Africa under that double tax treaty. Our local South African tax law, however, exempts foreign pensions. So in other words, there would be no tax payable anywhere. This is a minority of double tax agreements. So it's not all of them, but generally you would find that you would be either taxable in one state under a double tax agreement, or if I could say in terms of this scenario, non-taxable anywhere. So it's always important to remember, firstly, that not all countries have double tax agreements with South Africa. So your starting point is, firstly, currently there's an exemption in South Africa. Secondly, is if that is not applicable anymore, let's say the amendment was passed, or even currently if it doesn't classify as a pension and it's other types of investments, you would need to look at whether your country has a double tax agreement and what that provision says. And bearing in mind that not all double tax agreements are the same. So,
John-Paul, speaking of other types of products, you alluded to this now, and I want to get an understanding of whether or not the provision that we currently have in our legislation applies to other products like annuities and lump sums for South African tax residents if they hold these sorts of products offshore.
It definitely does, but also important to remember in terms of the referred to it as Regulation 28, where retirement and pension and those types of annuities are taxed very different. So you need to make sure that where you are investing in certain offshore products, that it is classified as a retirement or pension benefit. There are instances where some of these products are promoted as such, but actually there's a binding ruling with SARS is still valid. If I'm correct, binding ruling 80 refers to these types of products, and they are not generally classified as retirement or pension benefits. So it wouldn't fall under that exemption. So just there are some scenarios where clients actually have brought this up, and the unfortunate reality is that it's not protected under that exemption because it's not classified as a lump sum from a retirement or an annuity or a pension, for example.
And this is why it's very important to have conversations with your tax consultants, tax practitioners, and financial advisors, because this show does not provide you with financial advice. John-Paul and his team might be able to, but you'd have to contact them directly. For now, we'll leave this conversation on that note. Thank you so much. Thank you so much to John-Paul Fraser of Tax Consulting South Africa for joining us to take a look at the reprieve provided for foreign pensions in South Africa at the moment.